What's up, everybody? Today we're talking about my real money $118,331 portfolio. I'm going to talk about a full November update. How did the portfolio do during the month of November? Right now you're looking at all time, which this portfolio was started on February 15th, 2022. You can see we're down $14,736. So I'm going to talk about November. I'm going to talk about the risks of a recession and how I'm planning to adjust my portfolio as we go into 2023 and what is very likely a recession as well as a high interest rate environment. I have now broken this down into 4 categories. I've got cloud and SaaS stocks, which are down huge, $20,000 loss. It's showing down 28%. Advertising and e-commerce, I'm going to go into what each stock is in each of these individual categories, is up $4,700. EV, space, and semiconductors up $1,300, and then high dividend MLPs. I don't have any bought yet, but I've made this a new calendar, which is what I'm going to get into at the end of the video when I talk about how I'm planning my portfolio into 2023. Let's talk about November though. So you can see over the last month, and it's a little bit longer than November, it's from November 3rd to December 3rd, whatever. We're up $10,000, up 9%. So nice little rebound there. And the major outperformers, advertising and e-commerce. Then cloud and SaaS up 4%, and EV, space, and semi up 4%. So let's jump into each of these categories. And we'll start with the one that I have the most money in right now, which is cloud and software as a service. And you can see we own Snowflake, Datadog, CrowdStrike, GitLab, Cloudflare, Build.com, Mongo Database. Why am I invested in cloud and software as a service companies? These are unprofitable companies, but they are in an industry which is cloud and essentially, different types of software platforms and software services that just have a ton of growth potential ahead. If you think about the Googles of the world, the Amazons of the world, the Microsofts, not that any of these companies will become the size of those, but they were investing into trends that lasted a decade, 2 decades, and are still growing in the future. The idea here is that these are unprofitable companies at this time, but I believe I'm in industry leaders, industry disruptors, and companies that have a lot of growth ahead. So I'm willing to accept the unprofitability for now as they're making progress towards profitability to what I think will be great returns in 5, 10, and 15 years. But again, just my opinion. But I haven't made any changes. I haven't sold any of these, and I have no plans of selling any in the future. Jumping over to advertising and e-commerce, this is really just made up of Meta, which is my largest position overall, $25,000. Shopify, which is at $13,000, and Mercado Libre at $5,000. These are just 3 companies I want to own to get behind the trend, which I believe is going to continue, of online advertising, digital advertising, and e-commerce, people buying things online. And we've got essentially, most of the globe in the markets that I want to be in and have covered by these companies. And I just feel great about these companies and the growth opportunities ahead, as well as the major sell-offs that we've seen that I believe has given us a wonderful opportunity to buy into these positions and dollar cost average into them over time. EV, space, and semiconductors is probably the most risky of categories, just because of the types of things that could go wrong with like Rocket Lab and Tesla. We've got Rocket Lab, Tesla, and Taiwan Semi. Taiwan Semi, they are a massive partner for Apple. They are just essential when we think about electronics and chips, and they're expanding into the US. There's a lot of risk with where they're located in Taiwan with the China risk. That I think has given us a discount on the stock, and Warren Buffett apparently feels the same way as well. He bought a large position over the last quarter or so, and will probably continue to add to that position in the future. And then finally, high dividend MLPs, right? This is a new category I shared in a previous video. Just look back on the channel, as I think the video maybe 2 prior to this, talking about why I want to be invested in MLPs. There's some amazing tax benefits, even in a non-retirement account, which is actually where these should be owned. I referenced Simply Safe Dividend, which has, they do incredible research. It's just a highly respected service that I subscribe to. This is not an advertisement. I pay them. They don't pay me anything. I get nothing from saying this. But they actually analyzed all the MLPs, and they had a list of their favorites, and these are their 5 favorites, right? And they look at the safety of the dividend, the historic track record. And so the 5 that I'm going to own are Enterprise Product Partners, 7.6% dividend yield, rated with a safe dividend, uninterrupted dividend streak of 23 years. Magellan Midstream, 8%, 20-year uninterrupted dividend. Cheniere Energy Partners, 5.1%, 14 years of uninterrupted, a little bit riskier dividend there. All American, one of the most risky of the five for sure, 7% dividend yield, borderline safe, and then only had dividend growth of 1 year, or actually dividend payments of 1 year, uninterrupted. And then Cross America Partners, again, a little bit riskier here, but 10.5% dividend yield, borderline safe, and 3 years of uninterrupted dividends. This is a free article. You could just Google Simply Safe Dividends, MLPs, and you'll find it. If you want to read more about them, or just check out the last video on my channel that talks about why I want to buy these MLPs. Okay, what happened with my companies, which is kind of the most important thing over the last month, right? And we'll just really cover the month of November. So we had Datadog, Mercado Libre, Bill.com, Cloudflare, Rocket Lab, CrowdStrike, and Snowflake report earnings. You can see every single one of them beat on adjusted earnings per share, and everybody except Mercado Libre beat on revenue. You can see their upcoming earnings announcement date and what's kind of expected from an EPS and revenue perspective. And you know what a lot of people are going to care about, and especially when we talk about software companies, is enterprise value to sales. So Snowflake is still trading at a pretty high enterprise value to sales at 24%. But year over year, they grew revenue at 81%, and moving forward, they're still supposed to grow right around 73%. That will very quickly bring this enterprise value to sales down to a more reasonable level. CrowdStrike, same kind of deal, right? 58% year over year, 50% looking forward. Rocket Lab's kind of messed up, and it's not a software company, obviously, but enterprise value to sales of 8 with 269% revenue growth year over year. And they don't have it forward here just because it's a smaller company, I guess. But still very strong revenue growth. And they're in the very, very early stages of the space economy, essentially, which is a broader trend is why I own Rocket Lab, and I think they're an excellent operator. They have an excellent track record in that industry. Cloudflare, again, 18 enterprise value to sales, 51% year-over-year revenue growth with 45% looking forward. Bill.com, same deal, high enterprise value to sales with 76% forward revenue growth expected. Mercado Libre, e-commerce company, not a software company, but hey, a 5 enterprise value to sales, which is historically low for them. 54% revenue growth with 48% looking forward. Datadog, 15 enterprise value to sales, 74% year-over-year revenue growth with 54% forward. And so you can see the trend, right? These companies are expensive. A lot of people would never want to own these. And that's okay. I've gotten roasted for owning them so far, and they were even worse back in 2021 at their enterprise value to sales levels. But in my opinion, the problem with these are not that the companies are bad. They're not crappy, terrible companies like Nikola or Tattooed Chef or Oatly or those types of horrible companies which I would never want to be invested in. They just got way overvalued and people were way too excited, including myself, about them. There's a difference between the wrong price and a bad stock, right? Or a bad company. I think now we have a much better price with still fantastic companies, which means that I certainly want to continue owning them and think that now is a great time to be building positions in them. With that being said, I'm not going to continue to just pile everything into these 5 stocks because I have enough invested in them right now for me, where if they worked out and they double, triple, 5x, whatever over the next 5, 10, however many years, then that portion of money that I have invested in them, that $45,000 turns into $90,000 or $100,000 or $200,000, $250,000 if things really work out. And so I do want to diversify and own some other great companies in other sectors as well. So I don't have everything in cloud and SaaS, right? The last thing, let's talk about recession. 2023 recession, 2022 recession. We're probably in one. Who knows? I am not going to change my portfolio and own companies just to own recession-proof companies or recession-resistant companies and sell everything else. Because recessions happen. They happen on average just about every 5 to 7 years. They are a normal, healthy part of a functioning economy. You have got to have recessions to have a healthy economy over a long term. If they don't happen, then things get way too high and way too expensive, and people are just spending, way too much money that they shouldn't be spending, and things just get way out of whack. Recessions reset that and keep us on, this upward incline over time that is healthy for an economy. So if we're in one or not, I really don't care. I don't think, just based on data and history, we are going to be in a once in a generation type depression environment. With that being said, it might happen and I might be wrong. But if you just look at how rare those are and how many we've had, we had one in 2008. We had one arguably in 2020 that turned around really quick. Those happen, like a 2008 style recession happens once every 50 years or something like that. And we had one in basically 99 to 2002. And then we had one from 07 to 09. And so we've had ours, right? And what happened, I think, we're looking at the S&P 500 right here. And we're looking at the average over the last 20 years, the average PE of the S&P 500 over the last 20 years. You can see the S&P 500 just got too expensive. It was at a price to earnings ratio blended, so you might see this different if you look at other places, of 24. That's just too high. This is where the average has been. So we needed to sell off. We needed to have a normal sell-off. And that's a sign that we are in a frothy environment and a recession is probably due to keep things in check, right? And so all we've done is we've sold off. And I made videos back down when we were at like 16. I was like, hey, I think we've pretty much sold off to somewhere near the bottom if you just look at the price to earnings ratio historically. And so now we've seen the S&P 500 rally a little bit down from 357 the SPY up to 406. So that's a nice little rally. And I think right now we're in a place where I wouldn't be surprised if the S&P 500 as a whole went sideways for a few years. I wouldn't be surprised if we dropped 10%. I wouldn't be surprised if we were up 10%. And that's the thing, that those are the ranges that happen naturally in the S&P 500. But what I do know, 2 out of 3 years, the S&P 500 is positive. 1 out of 3 years, it's negative. I want to be invested because I am not investing money that I need over the next 3 to 5 years. And I'm not taking excessive risk with options or leverage or margin or anything like that. And so I'm owning companies that I'm happy to own for as long as the thesis continues to play out in the air, strong businesses for 5, 10, 15, 20, 25, 30 years. Because I don't plan to need this money. Any money that I might need in the next 5 years, I don't have in the market because I don't know how to time the market, right? And in hindsight, it's easy to see that we should have sold everything and been short. But the reality is most people aren't paying attention to that. I think the better way to invest is to have your cash cushion, live under your means, save money, focus on increasing your skills, earning more money over your lifetime, investing more money, saving more money, enjoying some of your money a little bit, but not, letting your lifestyle creep up as much as your income increases, and just trying to invest more money over time. That's my strategy. And if you like this content, if you appreciate this transparency, then do me a favor and hit a thumbs up on the video, subscribe to the channel. That helps people find us and it costs you nothing. So just come back and watch more videos. And I talk about long-term investing. I evaluate growth companies and I talk about what I think might happen over the next 5 or 10 years. I'm going to be wrong about a lot of companies and I'm not going to make any promises to make anybody rich overnight. That's not my job, right? Your investments are your own decision. So if you like it, subscribe and come hang out and join the journey to be a long-term investor.